Hello everybody and welcome to this new video on HIMSS. So I titled this video, Where Will HIMSS Be in 2025? Thinking long term, the market can't ignore you forever. And the reason why I say that is because HIMSS has been kind enough to remove a lot of uncertainty for us shareholders because it's given us long-term guidance, right? They gave us that about 5 months ago, and when they gave us that guidance, that would have been 3 years out. So this is the guidance that we'd find out sometime in early February or late January 2026 is when we'd find out if they will have achieved that or not. I say this is foolish for them to do. HIMSS is one of the few companies that has been foolish enough to give us 3 years out guidance because the market is giving them absolutely no credit for that guidance. The stock started trending towards the low teens, and then it went right back down, and the market went right back to short term, to asking itself, why haven't they released anything for weight loss yet? What is going on? They're not selling weight loss products, entirely ignoring the guidance that was given. But the point that I'm making is that just like you may remember that stock last year when it was trading near the $3 mark, it didn't stay long at all near the $3 mark. And I believe that over time, as quarter after quarter, this company keeps having more and more revenue, keeps showing great growth number, the valuation is going to get even lower as those fundamental numbers get adjusted up. And at some point, there will be a bounce. The market can't ignore you forever. That's really the title that I'm making about this video. And what did they guide out, right? So they guided, and this is something that we'd find out in very early 2026, they guided for $1.2 billion, trailing 12 months is what they've guided, at least $100 million of adjusted EBITDA, and they've also guided for a 75% gross margin and 25% adjusted EBITDA. The gross margin, we kind of knew it would be in that range. That's what they've had roughly, so nobody assumed it was going to go down, so that we kind of knew. Adjusted EBITDA is a new guide that they provided, and that should please and attract a lot of more traditional finance folks and value investor. As you know, in my style of investing, I care about gross margin more than anything else, but these numbers are absolutely outstanding in my view, and the fact that they've guided them is great for us retail investor because it removes uncertainty. It's foolish for them because they got no upside from guiding that, in my view. That's why so many companies are reluctant to give a long-term guide like that. But thank you, HIMSS, for doing that. And today I was thinking, HIMSS is becoming a substantial position for me. Even as I was on vacation, I was buying HIMSS here and there. And so I was like, okay, well, let me make sure that, I know what I'm doing here. Let me make sure that I'm not making a mistake. So I went ahead and I re-listened this morning to the last conference call, the Q1 2023. I listened to the whole thing again. The conference call that, the only thing that you may remember from that conference call is that Andrew Dudum was on parental leave. For some reason, it's the only thing that Twitter has remembered, despite all of the great things and all of the confidence that was showed in that conference call. And I also listened to the Bank of America Global Healthcare Conference, where Yemi was in that conference, talking a little bit about how they do business. A very interesting conversation, much more comprehensive. Both events were held in May 2023, so kind of the freshest data, one of the freshest, most recent time we've heard about the management. And after listening to it carefully, again, it is clear to me. I mean, we already knew they were sandbagging, and I've said that in multiple videos that this was sandbagging. But listening to them, especially to the Yemi conference in the Global Healthcare Conference, BOA, and based on my interpretation of their tone and the way they speak, it's clear to me that the 2025 guidance was very conservative and that they will beat. As you saw for Q1, they've already raised their 2023 guidance, right? They've revised it upward because they had already beat the numbers for 2023. So will they revise upward their guidance in Q2 again? Probably. That would be my guess. They keep revising up, and I believe, or at least that is my bet, my intuition, my opinion, not investment advice, but from what I hear, I believe that they will handsomely beat those numbers. And so for the sake of simplicity, instead of increasing the numbers, let me just in this video assume that they reach their goals early. And by early, early, I mean 6 months earlier than what they've guided here, right? End of 2025. I mean mid-2025. So let's assume that by now, right, by May/June of today, they've roughly reached those goals, right? So what if they reached them 6 to 9 months early, which to me, I believe they're on track of doing based on the tone. So what if they did that, right? How cheap would HIMS be? Well, let's go back into the number, and I put this smiley face right here because it's really hard to believe that stock could get much cheaper. But assuming the stock price does not change within the next 24 months, so you would get the same enterprise value, right? You'd get an enterprise value of 1.63 billion, and assuming no change in that enterprise value, given what they've guided, you would get an enterprise value over sales of 1.36, right? Mind blown, absolutely insanely cheap. It's not possible for a company growing that fast to be that cheap, but I guess that's what would need to happen, right? For the stock not to move. 900 million gross profit would be a 1.81x. So again, that's be dirt cheap too, and 300 million in adjusted EBITDA. So that would be a 4x, and of course, enterprise value over adjusted EBITDA is typically much closer to a 20, even 25, not a 4x. So this would be an extremely cheap stock. And even if you were to think like a value investor and be like, okay, what would be my cash on cash return, my free cash flow return using adjusted EBITDA as a proxy for cash flow, you'd be at about 25% return per year in just 2 years. That would be the run rate, assuming that level of adjusted EBITDA. So again, absolutely a dirt cheap stock, especially for a company that, let's remember, does not have to fight for every sale it makes. Once HIMS makes a sale, it's recurring revenue, sometimes 3, sometimes 5 years. And then the company hasn't been around for that long, but it's going to be longer than 5 years. It's a recurring revenue that keeps coming back, right? We also know that you have single month and multi-month subscription. HIMS has been doing really, really well, having an uptake on their multi-month subscription, because, for example, if you get a pill for hair loss, you got to wait, 3 months, 6 months for the results to show up, and when people go into these multi-month subscription to make sure that HIMS shows them that the product is working and that they don't cancel in month 1. So that's also part of what they're doing. Recurring revenue is very, very powerful. That's why I can't understand how cheap this stock is, because part of the reason why SaaS is so heavily valued, why the valuations is in software as a service businesses is so high, is that recurring revenue. HIMS, under the guise of an online pharmacy, is actually a special type of online pharmacy that has 95% recurring revenue. So to me, those numbers should go way up. They should go way up. There should be a valuation reset. Again, just my opinion, not investment advice. Anyways, moving on, and let's do a little math. So let's assume these number happens compared to today, right? So we've calculated what they would be in the future. What are they now, right? So now enterprise value again is 1.63. Trailing 12 months revenue as of May 2023 is 527 million. Gross profit as of May of 2023 is 401 million. So the stock right now is trading at a 3x revenue and a 4x gross profit. And assuming that the same depressed valuations hold in May 2025, what would we get? Applying these ratios, what would we get with the updated revenue, right? They guided 1.5 billion is what they've guided. So assuming 1.2 billion, sorry, assuming 1.2 billion in May 2023, you do 1.2 billion times 3.09, you get 3.7 billion in enterprise value. That would be a 2.27x from here in 2 years. And with gross profit, if you do the same math for gross profit, 900 million in gross profit is what I predict they will do in 2025. And you apply the same ratio as it is right now, i.e. a 4.06, you'd get a 3.65. That would be a 2.25x from here in 2 years. So that's just about 50% cumulated growth rates, right? Average annual growth growth rate, your growth rate would be about 50% a year, right? 1.5 times 1.5 equals 2.25. So that's where you'd be. Absolutely outstanding return, assuming that these valuations stay as depressed as they have been 2 years from now. And with the Fed dropping rates and the economy getting back on its feet, I have a hard time believing that. With the cross-selling that HIMS is working on, I have a hard time believing that. With the new categories of product that they will eventually launch, even though they're taking their time right now, I have a hard time seeing that, right? Seeing those numbers stay that low. And can we use adjusted EBITDA to estimate any price? I do not think so. I think this is a company that is nowhere near being optimized for adjusted EBITDA and won't even be in 2025. So that's not a number that I would use, even though I have no doubt that value-oriented investors will love the ratio and will love the way it looks like and may enter the stock. This, at this point, is both a growth stock and a value stock. It's a hyper-growth stock that's trading like a value stock. It's really the best of both worlds, in my opinion. No investment advice. So again, HIMS is both. And when you see the price, $8.35, it's actually only 16% up from August 2022. Okay, I'm picking the most advantageous points on the chart here to show you. But if you missed it last year, yeah, you can get it this year. It's very, very cheap in my view. And the reason why I say why it's not just a value play, even though if you were to look at the number alone and the numbers alone and not look at the growth, you'd think it's a value play, but it's not just a value play, because this is what I showed in a prior video. The revenue in the past 3 years for HIMS has been multiplied by 6.3x. They multiplied their revenue by over 6 times in 3 years. That is the magic of a growth stock. And to me, this stock is so undervalued. And I am working right now on a deep dive, similar to what I did on End Phase, on HIMS. So wait for it. Subscribe to the channel if you're interested in HIMS. There will be a 1 hour plus video that I make on HIMS, going really through the thesis and through everything in it, because this is a stock that's more complex than it seems. Right? There needs to be a little digging done, and I will do that for the channel. So, anyways. This is obviously not a prediction, not an investment advice. This is just entertainment. I hope you were entertained. Appreciate your likes, appreciate your subscriptions. Have a wonderful day. Thank you for watching.